Well, we've got equity markets ripping higher, particularly the NASDAQ. It's looking at a gain of nearly 3%. Now, many are saying the reason or the key catalyst was the fact that jobless claims came in less than expected. I can't remember the last time jobless claims were a catalyst for a 3% NASDAQ rally, but it's probably because that there are underlying fears, right, about the slowdown in the U.S., and that was really driven home by that weaker than expected job growth that we saw on Friday. Let's bring in Veronica Clark, economist at Citi. Veronica, I imagine you've been so busy over the last couple of days fending off questions about, is the U.S. economy falling off of a cliff? Has your assessment changed since the Friday jobs number?
Yeah. It's not that we've seen, any flashing red signals for the economy entering a recession, but that actually has been our base case. So we haven't changed our views. It's not, abundantly evident yet, but we have seen these weakening trends in the labor market for some time. We are, well off the lows of the unemployment rate. We had the low of the unemployment rate in the U.S. at 3.4% as of April of last year. And it had been, somewhat consistently rising. And then before Friday's data, it had been even more consistently rising, a tenth every month. And then I think those fears, obviously got compounded when the unemployment rate did just go up a tenth. It went up 2/10. It looks like that weakening is accelerating, if anything. So we haven't changed our views that, we are on actually the brink of a weakening economy, a recession. And I think the market obviously caught on to that on Friday too.
So you are using the R word, a recession, short, shallow, something more prolonged. How do we think about that?
Yeah. I mean, we're not talking, I don't think, of course, about a 2008 kind of scenario. It doesn't really look like anything is necessarily breaking, but this would be a slowdown, a contraction, some kind of normalization, a recession, because rates are very restrictive. I think it was taking a lot longer this cycle to play out because we had factors like such substantial support from fiscal policy, of course, immediately post-pandemic and even in the years following, things like infrastructure spending, the CHIPS Act in the U.S., all of that was supporting activity for a while. But as that is starting to fade, that is peaking. Rates are still very restrictive, and we've gotten a lot more reactive to that this year.
Is this going to show up in inflation? Because I think that would be the only solace here is if at least inflation comes back down to target. We'll get a read of that, of course, next week.
Yeah, of course. And we do have, a couple months now, really data for May and June where we did see inflation slowing a good bit in the U.S. Obviously something that looks a lot more favorable for the Fed. We think we'll see that again in July data, July CPI next week, something like a 0.2% month on month. Even in things like shelter inflation, which has been really sticky, we finally saw that slowing in June. And just fundamentally, as the labor market is loosening, we saw this on Friday also. Wage growth is slowing. Those underlying price pressures for services are slowing. So yeah, we should get inflation easing at least.
Are we going to get a 50 basis point rate cut in September?
That is our base case. Yeah, okay. Absolutely. So, we obviously had the Fed meeting last Wednesday. I think there is this sense that, of course, Fed officials are, much more focused now on their dual mandate. They target, price stability and maximum employment. We already knew that those, goals were in balance. The risks around that were in balance. And if they had Friday's employment data, maybe they would have even been cutting last week on Wednesday. So in September, there is a bit of this, makeup. You're catching up for lost time. You're well, above a neutral rate. It's easy to get rates, lower pretty quickly now.
Where do we settle out then? What is the neutral rate? Where do you think how many rate cuts do we get this year, next year?
Yeah. So we're penciling in. We do expect more weakening in the data. Even if we don't quite see that before the September meeting, I think the bar is pretty low to get that first cut as a 50 basis point. Making up for some lost time. But we do expect more weakening of the labor market data, which would get them to do 50 again in November. We then think they do slow to 25s, but cutting every meeting. Getting back to a much more neutral policy setting, something around 3%. By middle of next year.
Let's contrast this with Canada. We only have about 60 seconds left, but we thought maybe there was going to be a divergence between Canadian policy and U.S. policy. Looking like that might not be the case.
Yeah. I mean, the Bank of Canada is in a bit of a tricky situation. The BoC has essentially been expecting that the bottom in growth in Canada is in, and we're going to be picking up into the second half of the year. But of course, the Bank of Canada has already been cutting, each meeting starting in June, so 50 basis points ahead of the Fed in that sense. I do think maybe they do just another 25 in September, but as the U.S. is weakening, that's downside risk for Canadian growth also. I actually think the Bank of Canada is going to cut 50 in October.
In October, you think they're going to cut 50 because of weakening economic data?
Yeah, weakening in the U.S. is an external shock that they were not exactly expecting when they did their forecast update in July. We'll see the employment data tomorrow. There's absolutely a chance that they could be cutting 50 in September also. Similar issue where Bank of Canada is far from neutral still.